Yeah, we're live now. So hide the trademark, like from that. Welcome guys. The Cakeinator's here already. I miss Cakeinator. It's good to see you again. It's always good to see you on these live streams. So tonight we're going to do a very educational presentation with Lance. Maybe just introduce yourself, Lance, because there'll probably be some people that haven't actually met you yet. So yeah.
Yeah, so I'm Lance. I'm a high school science teacher during the day. In my 20th year actually now, and I've been teaching how to sell options for I don't know about 6 years now. It's hard to count the years as you keep doing this over and over. But I run an option selling Discord. We have something like 400 members or so. Quite a few people. Like Kate Ganator has been here quite a while, and then we got people coming in throughout. So I primarily sell options to get consistent income. I also do help with the buy side with Russell and Phil. If you've ever seen Russell's live streams on his YouTube channel, we do some buy side as well, but we're going to focus on the sell side today. And we'll do a buy side one probably in a month or so, I think, just because I like having both ends of the coin. The sell side, as you'll see in the slides that I'm going to go over, they're usually much more consistent, highly probable trades, but you don't necessarily make as much per trade. And then on the buy side, those are the ones that have usually a lower probability of it working, but you can potentially make more as well. So I've been doing a little bit of both at this point now, depending on what the market conditions are. Like obviously, if we're more in a bullish outlook, you typically want to buy options. When volatility now has been increasing, sell side is usually more preferred in a lot of different cases because you typically want to sell when there's a lot of volatility. You could go even further away from the current price, or you could make more premium for a very similar price, as we'll talk about. So I have the slides ready. If you want to share my screen, Russell, we can get going.
Sure. You need to share it on your end. I don't have.
Present.
Down the bottom, share screen, and yeah. So guys, say hello in the chat. Make sure you have loads of questions ready. This is going to be pretty much a tour de force of option selling. So it's going to be pretty interesting. Lance has been doing this for a long time now, and he does it extremely well. So yeah, let's get going with some of the slides here. Let me make this full screen so you guys can see it a bit better. Let's see. Hey, Jeremy. Thanks for doing this tonight. Yeah, no problem. This should be pretty interesting. Make sure you got your questions going. Let's just make this full screen so you guys can see it. All right, that's fair. All right. Ready when you are, Lance?
Yeah, feel free to ask any questions. I usually have like slides that say any questions, but as you guys post them, if you see anything, definitely stop me. And I don't want to make this go too long, but feel free to ask anything as you have questions on it. So we're going to be looking at probability-based income strategies and also looking at risk management. What I see a lot of traders do, especially on the sell side, is they don't have much proper risk management. A lot of times they might be over allocating into one position, or they don't have defined risk strategies for like undefined stop losses and whatnot. So we'll focus on that as well. First, what is option selling? Because a lot of people that watch these are typically on the buy side. Sell side is pretty much the exact opposite of the buy side. So when you have an option, it's controlling a contract with 100 shares of stock. If you buy an option, you're going to be pretty much owning 100 shares depending on your delta. When you're selling, it's going to be having the obligation to possibly take in the shares at a certain strike price. However, it is probability based and more income focused. When you sell an option, the maximum you can make is the initial premium for just one sold option. There are other ways around it where you could do combinations. You sell an option and buy an option as well, or buy debit spreads. But we're going to just focus on just straight selling one option as well. Now, time decay does work in your seller's favor. So when you're buying an option, you have a limited amount of time for that position to go to like a certain strike price. Let's say that the stock doesn't move at all and volatility doesn't move at all. At that point, theta will start to decay, and that's time decay is called theta decay. where every day you get closer and closer to the expiration date, you have less time to make that move that we want. By doing the other side of the coin and selling options, the time decay works in your favor. So if you sell an option that's say a month out, and then the stock doesn't move and volatility doesn't move, when it's only a week out, you're going to have much less time to make that possible move. If you sold that option, then you're gaining more in that theta decay. And then again, it could be a highly probable income approach for people that might be a bit busy. If they're wanting to do a little bit more set and forget, you could sell longer dated options, and then put alert prices. That's typically what I do since I'm teaching, and I'm not going to be looking at every single position every minute of the day. So there's an example of one. I took this, I think, yesterday. So thicker swim platform, that's a lot of people use. You could sell an option here, and let's say you want to sell the 650 put strike price. You could have taken in $405 for selling that one put. This is not very buying power efficient. I just wanted to show how it is a very highly probable trade, because when you look at SPY currently, we're at 681 or so. So if you sold a 650, you're going to be in much better probable shape for it to work out. Now, some of the rewards for selling options, you collect the premium up front. So if you have a lot of cash on the sideline and you don't want to make the T-bill interest rate of, say, 3.5%, 4%, what you could do is sell a cash secured put. And if I sold this put right here, you would take in the $400 immediately into your account. You will also hold the amount of funds needed for that option. But based on that, you get the highly probable setups. You could go pretty far out of the money and then have theta or time decay working for you. Typically, you want to do defined risk spreads, though, and not an undefined risk, like I showed before. So if you look at this example, here I'm selling a put. You could say you sell a 630 put, and then you buy a put a little bit below that price. So if you sell a 630, you could buy the 625 put. This makes it a defined risk credit spread, because if the market went down below the 625, at that point your bought put will be gaining value, and it'll gain the same amount of value as the 630 sold put would be losing value. So having a defined risk trade is not only good to not blow up your account, but also it's good for smaller accounts that can't just sell a 630 put in this case. I actually have a second image with this. I showed also for, this is an example that you don't necessarily want to do. You could sell call options. That's where it's essentially a naked call in this case, because we're just selling a call and assume that you don't actually own the shares of SPY. This is an undefined risk trade, and it can be very dangerous, because I might be taking in $103, but what if SPY just shoots up and it goes to 800-900? At that point, you're going to be losing a ton of money, because you have a big difference between the 703 and where you're selling and where the current price is. Some of the risks, again, undefined risks that I just showed with the naked calls. If you have large adverse moves, I was mentioning a lot in my Discord where you want to stay a little bit low in options selling when the volatility was lower. But then with the war in Iran and a lot of news events happening, the volatility has increased lately. So you want to be taking advantage when the volatility is higher. Also, your margin use, if you're using a lot of your account to be selling credit spreads, and then you have a big down move afterwards, that could be pretty dangerous. And you also have emotional discipline whenever a position goes against you. Are there any questions so far?
Not seen anything yet. I think it's worth pointing out that we we did a conversation with Jason the other day about how this is basically, you're the casino in this case, right? Where you really are stacking the mathematical probability in your favor, selling options rather than buying them. So it's worth kind of hammering that point home for anybody who hasn't actually, gotten into selling options yet. For people that have, it's pretty obvious. But for people that haven't actually tried selling options for premium, that's a huge advantage, right? That you have.
Yeah.
Um,
And then going along with that, like a casino over time has a highly probable trade where they have a net positive expectancy, but that's over many trades. If you had a big billionaire coming into a casino and putting $1 billion on red, if it happened to hit red, the casino could go bankrupt, even though technically the probability is on their favor. So that's why you want to have many different trades and also keep your position sizing relatively small and not just go all in on one particular position.
yeah, so we do actually have a question from Jeremy. It just came in. It might not be relevant right now, but I'll put it on the screen and we'll keep going. Can you see it?
Yeah, I'll just read it out. When we get to the point of time, my question of these is knowing when to close and keep premiums or when to let the final day expire. It depends on a lot of situations for that. There's not necessarily one quick, easy answer to it. One of the things to consider is figure out how much premium you're taking in for the amount of days when you enter the trade. So let's say you're taking in, just to make the math easy, $300 in a trade and there's 30 days. You're essentially making $10 a day because you do 10 times 30 is 300. And then you could see if you're 10 days in, if you already took 150 or $200, so you're taking in more per day than what you started with, that could be a good possibility to close it. It also depends on technical analysis and how much time you have to actually deal with the trades that you have.
Yeah.
It's pretty much the shorter answer to it, but it could definitely get more complicated depending on what's actually happening with the market.
Yeah, and like use a strategy, right, where you actually close at 50% premium, right? That's something that you've kind of advocated for over the years. It's kind of yeah.
At times closing it out at 50% profit. The simple math, if you could close it out at 50% profit in less than 50% of the time, like in the trade, again, 30-day trade, if you see a 50% profit in say 5 to 10 days per day, you're doing better that way. The issue though is if you do that, what are you going to do with your funds afterwards? You might take in another trade of the same stock and you want to take in even more income, and then maybe you go with a higher strike price or closer to the actual stock. And then what if it reverses at that point? Then suddenly you had to essentially manage the second trade, where in the first one it might have just worked out with just leaving it alone. So it really depends on the time commitment you have as well. What I've found in doing this is over time, it doesn't make that much of a difference to just let them expire or just close them out early. Because I was pretty active trading, and especially in the summer when I'm not teaching, I would do quite a few trades where I'd close them out early and then enter new ones in. I haven't seen a huge benefit to doing that, and that's just my personal experience. It's not necessarily to say that it wouldn't work in your ends.
Sounds good.
All right, so we're going to quickly go over covered call, credit spreads. An iron condor is just another credit spread. I'll show that a little bit later when we look at Thinkorswim. Let me go over some of the Greeks first. So they're option Greeks. This is all based on the math of the actual option premium, the moneyness, how far away you are from the price, the volatility, and all those factors. The main ones you want to look at are delta. Delta measures the directional exposure. So if you're buying options, and let's say you buy a 0.8 delta, then you're essentially controlling 80 shares of stock with buying that one contract. It's more buying power efficient than buying 80 shares, but you have a time limit in terms of the option expiring at a certain time. It also is an approximation, it's not exactly, but an approximation of The probability of going ITM means in the money. So in the money is when you are, say, lower than a sold put price. Let's say you had a stock where you sold a put at 50 and then the stock's at 48. That'd be in the money at that point. So when you initially sell, let's say a 0.3 delta put, you would have approximately 30% probability of it going in the money. What that means is there's about a 70% chance that it wouldn't go in the money. So a lot of brokerages and a lot of websites will say, you have a 70% chance of profit in this particular trade. That typically has to do with the delta. Now, if you go with a higher delta, you'll be taking in more premium. However, there is more risk because you'll be closer to the current price of the stock. If you're at a lower delta, I typically look for around a 0.15 delta in most cases. On my covered strangles, I'll typically go a little higher, around 0.2 to 0.25 delta. That you'll get more premium with a little bit more risk. And if you want to be very passive, you could go very low deltas. I sometimes do 0.1 delta, which means there's a 90% chance of it working out. So if you look at this image here, this shows SPY. I took it yesterday, so that's why the days are a little off here. 17 days out, and this is in Thinkorswim. You can see the delta column. It was at 680 when I took the screenshot. And let's say you sold a 630 puts are on the right, it would be a 0.12 delta, which means that there's approximately a 12% chance that we would get to the 630 strike price at expiration on March 20th. And if you could just do the opposite, 100 minus 12, it would be an 88% chance that it wouldn't get there. As you get closer to the current price, let's say you're at 648, that is a 0.2 delta. So again, 20% chance it could get down there. You do take in more income though. The bid ask is where you're taking in your premium. If I sold a 630 put, you get about $255 or so. If you sold a 648 put, you're getting about double, $444. So there's no way around it. A lot of people and different trading groups will say you're going to make a ton of money and there's no risk. With more possible reward, there is more risk. There's no way around that. So if anyone's saying, like, I know the magic 8 ball of being able to make a bunch of money with no risk, I would not walk away. I'd run away at that point.
Cool.
I see a few questions come up.
Yeah. Dang Dang is saying, what percentage can I expect to win selling options? And that's kind of in line with what Jeremy's saying lower down about the delta as well. So
yeah, it pretty much has to do with the delta in many cases. So if you sold a 0.3 delta, you could say there's approximately 70% of the time you would win on the trade, and then 30% you would not win. If you go with a lower delta, you'll have a higher probability of it working. But probability isn't everything. If you're getting 90% of your trades working, but then the 10% of the trades you're losing quite a bit more than you're winning with, it may not necessarily be a positive expectancy.
yeah. So if you wanted a 95% win rate, for example, like that's just what you wanted, you'd go for a 0.05 delta.
Correct.
Yeah.
And we're going to talk more about why, again, that's not necessarily a good thing in most cases, because you have to be worried about your risk management when you're taking trades as well. All right, theta I did mention a little bit before. Theta has to do with the time decay. This has a seller advantage to it. When you buy an option, you're essentially controlling shares of stock and you're paying the theta. That's the intrinsic and extrinsic value of the option. When you sell it, you're essentially taking that in. You're almost like an insurance company that's taking in premiums to insure like your house or something. And then as the time goes on, let's say every 6 months you got to pay for your car insurance. When the 6 months is up, you got to pay again because the time essentially went to that insurance company. The longer out you are, the less theta there is at that particular moment. And then as you get closer to the 0 DTE, you'll have more theta at that point because the option is about to expire. So typically, I look at 30 to 45 days as a sweet spot where you get a decent amount of theta and you could go pretty far out of the money. Your delta, let me just think of the best way to say it. If you sold like a point 0.3 delta with only 2 days left, you have to be very close to the current price. If you sold the same point 0.2 delta 30 to 45 days out, you could go much further away from the price because there's more uncertainty of what will happen with the position when you have more time. So when I do my credit spreads that I do every day, I typically look around 30 to 45 days. Right now, I did one today. I think it was 44 days out, and then we go close to 30, sometimes near the mid 20s or so, and that is for more safer positions where you don't necessarily have to watch the market every minute of the day. I also do 0 DTE though, and 0 DTE is literally 0 days. That's where you have a ton of theta decay because the option is going to expire that day. Sellers want time to pass. So you typically want a stock to not move or move in the opposite direction of where you sold an option because then time is on your side and then you're just collecting that theta decay. So here's a image of theta. These numbers represent the amount of dollars that the option will decrease in value, assuming the other option Greeks aren't moving. So if I sold a 625 put, for instance, the theta would be 0.23, and the bid ask in this case was around $220 or so. What that means in the first day, the option would decay or go down around $23. So you'll be around $200 the next day, assuming nothing happened with the market. Like SPY just completely stayed flat and volatility didn't move either.
Yep.
See, another question came up.
Yeah. What exactly is theta though? And how does time decay make me money? Yeah, that's a good question because normally when you're buying options, time decay is a bad thing, right?
Yeah, because if you bought an option like that, let's say I bought a 625 put and it's not moving, it's going to be down $23 the next day. So even if nothing happens with the position, you lost $23 because the actual option premium will go down that much. So theta, this theta number is the amount of dollars that the premium would go down. So how does time decay make me money? If the position doesn't move at all, you would be making the $23 on this one day. Theta will also increase as you get closer to expiration. So this same option in, let's say, 1 day left, it's going to possibly be even higher than this. But that's assuming the other option Greeks are not involved. Like when you tie in all the Greeks together, it gets a little bit more complicated because as you're further out of the money, the options actually decay pretty strongly in the 30 to 45 days out. And then the premiums will be worth very little. Let's say that SPY didn't move at all. It's at 680 and there's only 2 days left. In that case, the theta would be very minimal just because the delta would be extremely low at that point.
Yep. Cool.
Next is gamma. Gamma measures essentially the speed of the change in your delta. So when a position is moving very quickly, the gamma will increase if it's going towards our position, and then that will change our delta as well. For gamma, it's typically, now it always is very high at the 0 DTE because as gamma moves, then the delta moves as well. I lost my screenshots here. Let's see. Similar image. So if you look at the gamma here, the gammas here were 0.0 because I went really far out, 318 days out. If I was at 0 DTE and I was very close to the current price, the gamma will be pretty high. if you have a dollar move in a certain direction, your delta will tell you how much the premium will change. And then as it moves closer and closer, the gamma could go increase as well, which influences your delta. That was a little confusing what I just said, but in general, you want to manage your trades early if you're worried about gamma changing the deltas a lot. For an example, let's say you bought a stock, or let's say a stock's at like $80 a share and you sold a 79 put. So it's really close to the current price. Your delta will be very close to 0.5. If that day, the day of expiration, the stock moves to 79, your gamma is going to be high, and that's going to change the delta very dramatically. Because suddenly, if you went slightly below 79 where you sold your put, you could get a sign on that contract. However, if you sold a 79 put when the stock's at 80 and you have 45 days out, if it went down a dollar, the delta is not going to change too much just because there's still plenty of time for the position to move. Does that make sense?
Yep, makes sense to me.
All right, so where do you choose strike prices? We're going to go over a little bit of technical analysis in terms of where I look for selling a strike. The deltas are interesting in that it is probability based. However, a lot of different positions will trade in a trend. Like you might see the stock go up to a resistance line, bounces down to a certain amount, gets to a support line, and it might hover between support and resistance. So if we're near the bottom of a support and then you sell a delta, I think, and I don't have actual anecdotal evidence on this, but I think that there might be a slightly better probability of not expiring in there just because you typically see it bounce off the support, and that'll be good for us because we're selling way below the support line. So here's a possible position. If you look at QUQ, you can see this trend line. So there's multiple points here, and I'm looking at the bottom of the wicks where it's around the 592 strike price. And you can see when it was near 592 in early February, bounced up, mid-February, bounced up,
Yeah.
early March, possible bounce up. So if you sold a put at around 580, 570, there's a pretty good chance that it's not going to get to that place anymore, just because they're hitting the multiple support levels. Just looking at questions here, none yet. Okay. You want to evaluate your risk and reward. So you always want to be figuring out how much premium are you taking in for the position, and is it worth the probable bet that it might work out in your favor. So in that last position, sure, you could sell like a 500 put. It's almost impossible to get down there, but you're not going to be taking in much income for it.
Yeah.
So if you want it to be more possible return, you could sell a little bit below the support line. If you want to go a little bit safer, you go lower delta, and you're going to go further away from that price.
Yeah, because guys, remember you're betting that something won't happen in this case when you're selling options. So we're betting that it won't go below that line rather than it will. And it's
Exactly.
Yeah.
So I kind of talked about that already. If you have a bullish setup, you typically want to sell a put below that support line, and typically want to look around a 0.2 to 0.3 delta in a lot of cases, because that gives a good balance between the potential return and the risk involved. If you see it trending sideways, you could do an iron condor. That's where you sell a put credit spread and a call credit spread at the same time. And you can also look at the expected move. It's close to a 0.16 delta. And if you sell a little bit lower than that, like a 0.1, 0.12 delta, you'll be outside the expected move, which has a pretty good probability of it not getting to that point.
Yeah. What expected move do you use on these things? Like,
can you see my Thinkorswim? I don't know if
Yeah.
it just popped up. All right. So Dash was one I actually recommended to members today. expected move is typically there's a few ways you could calculate it. One is you could look at the money strike. So 183.48. You add the put and the call premiums,
Yeah.
and then the difference of that, essentially from the current price, is the expected move in most cases.
Yeah.
And there's some multipliers of it as well. I typically look around 0.15, 0.16 delta for the expected move. It's also listed on Thinkorswim.
Yeah.
So you can see if I added 12.4 and around 12.9, you
Yeah.
get around 26.
Yeah.
So that's the expected move with Thinkorswim. Tasty Trade has a slightly different calculation for it. So it really depends on the brokerage.
Yeah.
But one way you can do it is if you're 26 away, I would sell maybe 30 away or 35 away without thinking about anything about the support and resistance levels.
So this is for the 0 DTE, 0 DTE, right? You're not looking at expected move for the week or anything like that, or do you?
Well, as we get further out in time, the expected move will be greater because there's more uncertainty. Like 43 days out, we're at 26. If I went 100 days out, we're at 46.
Yeah.
Because there's more time for it to move there.
Okay.
Expected move always increases the further out you go.
Right. But it gets lower throughout the day for 0 DTE, though. It gets smaller. The expected
move. It gets tighter because there's less time for the stock to actually make the move.
Yeah.
There's only like a few hours left compared to weeks left. If there's any other questions, keep them coming.
Yeah, keep them coming. There's no silly questions here. We have no idea what you guys are, if you're already option sellers or if you're people that buy options and want to know more. No questions too silly to ask here.
All right. Here's a little bit more technical analysis. Besides looking at support and resistance levels, moving averages is a very common one. I had one up for Dash recently. So for Dash here, you can see these are 3 different moving averages. I forgot off the top of my head exactly what each color is. The very fast EMA, these are actually fairly long out, but 50-day moving average is the yellow, orange. Why did I say yellow? So 50-day is the orange over here. The 100-day is the blue, and then the 200-day is the purple one. So you can see here, DoorDash has been below the moving averages pretty consistently since around January. However, we did see a big up move today. So that could be an indication that we might get close to this longer moving average. This could be a possible trade for a long dated option. If you go 8/21/50, that's another common one I use. You're going to see that we went above the 8 moving average here, and we close to touch the 21 moving average. So this was actually a possible position that I recommended to members. You could also see a support line around the 160. So 160 bounced, touched again around 160, bounced. And now we have a momentum move. We went above the 80 MA yesterday. We went way above it today. And I'm just looking at the Discord. I said for tomorrow, consider around a 155 strike. I had it on the screen right here. So this is a possible position tomorrow. Sell a put at the 155, this black line here. And then you can make it a defined risk trade. You're going to buy around a 150 put for the protection of it. So if in case it drops below the 150, you'll still be pretty safe on that sold put. And there's other things you could do with this. Like if you have a fairly larger account, you could take assignment on the put if it happens to get assigned, and then you could sell covered calls and wheel the contract. There's a lot of different ways you can manage these trades as well. RSI extremes. If you're at a very high RSI, that means that momentum might be starting to fade. So around 80 RSI, you probably want to be a bit reluctant to sell puts at that point. At a low RSI on a good stock, around 20 RSI, you would want to possibly enter a trade there. One of the common trades I'll do is when we're at a low RSI and then you see an up move. So for DoorDash here, we saw the big up move, the RSI did increase, and that's a possible put credit spread at that point. I see Jeremy wrote a question. Do you need to execute to protect yourself if it goes against you? Do you simply close both the sell and the buy put? Good question. I personally just close the sell and the buy put in most cases. So I'm busy teaching most of the time, and it's hard to be watching all my positions while teaching. So I typically do this as a probability trade where if you take in a certain premium, I'll stop out if it's a certain loss. However, there are other ways you can manage it as well. Some fundamental analysis. I'm not going to spend a lot of time on this, but you want to look for dividend dates, also look for earning dates. Strong companies in terms of increasing income, increasing earnings, share buybacks, dividend growth over time. In general, you want to avoid the low liquidity meme stocks. A lot of reasons for this. One is they don't have great fundamentals. It's usually based on just sentiment of people trying to make the stock go up. Also, the bid ask spread could be pretty wide on those, and you may not get adequate premium to enter or exit it. And then you always want to ask yourself, would I own the stock if I'm assigned? I've been typically selling credit spreads on, I have a watch list of about 60 different stocks, and they're mostly large and mega cap stocks. I'll occasionally do a mid cap stock, but in general, you want to stay away from the low cap stocks just because you may not want to actually hold the stock in a long period of time. All right, risk management. In general, you want to risk around 1 up to 5% per trade. I see a lot of members risking a lot more than the 5% per trade. And then it's like going to the casino and you own the casino, someone's putting down $1 million on red. Suddenly you could get completely ruined, even if the probabilities are in your favor. I typically risk around 1 to 2% per trade personally, and a lot of our members will do even less than that. You want to be able to have a lot of bets. So the best people for the casino owners are the blackjack players that they bet $5 a hand and they just do that for many hours because then they know the probabilities are in the casino side. Over time, they're going to be a net loss, and it's just going to have time in your favor at that point. For risk management, if you're a bit higher in the risk for trade, you might want to take profits early. I wouldn't bother taking profits before 50%. If you are more of an active trader, you can take profits of 50, 70% or so, especially if it happens in a short time frame. Cutting your losses, though, I personally cut losses at around 3x credit in most cases, just because if you have a big loss, that could offset a lot of the winners that you have. And also diversifying across tickers and different sectors. You don't want to do everything in the tech sector because what if the Qs go down a lot? You could get hurt in a lot of positions at once. So you want to look at consumer staples, more dividend paying stocks, some tech, and just vary it out among a lot of different types of stock. Trade management, when to close early or when to let something expire. I personally let a lot of trades expire because I do a lot of different trades and it's hard to manage everything at once. We have members that have zero DTE, longer dated futures trades. There's a whole bunch of them. So I personally let them expire, but a lot of members will ask me, like, what do you think about this position? Should I close it out early? And then it really depends on your, again, time that you have available to you and your position size. And if you also see other opportunities you might want to take. I know I mentioned it before, but a lot of people will want to take profits early on something. And then what are they going to do if their account? They might take a worse position on the next one, and then they could get hurt on that. Stay calm managing losers. This ties into having a low position size in terms of the amount of risk that you have. If you're only going to risk, say, 2% of your account on a trade, then it's not really that big of a deal if it happens to lose. All right, so live trade walkthrough. I wanted some member in the chat or someone in the chat here to pick a random stock, and I'll show what a possible position could be on it. So you guys that are in the chat, let's just write a random ticker, and I'll show you the steps that I personally go through for it. Don't be shy, guys. Just pick a random stock.
Yeah, somebody will type it. Go on, give us a ticker, anybody, or I'm going to have to pick one, and I have no idea which one I'm going to pick yet. Maybe
Is
I'll find
amen
one.
a stock, or you're saying good?
Maybe.
They said amen at first, and then I was like, oh, is that a
Amen.
positive thing about what I'm saying here? All right. Amazon, Nvidia, Iron, Apple. I don't know if I'll have time for all four, but I'll just take a quick look at these. Amazon, you can see the moving averages. We crossed above the moving average yesterday. We actually had a decent day today, even though the market was down a bit. We're above the 8 and 21 EMAs. We're close to that 50 EMA. It's a pretty bullish setup here. Resistance around the 198. Support at 198. You see multiple points here at around 203. So now what I would do is look at how much premium you could get between 30 to 45 days or so. It's like around 43 days. Again, around 205. I would like to go a little below that if possible. And you could easily go below that, around 190 or so. So a possible position is to sell the 190 put, and then to make it a defined risk, you buy the 185. And you can take in about $45, $47 on this trade. You only need the difference of these. 190 minus 185 is 5. So you only need about $55 to do this spread. And you can make $50 off it. So that's a pretty good percent return. So you get about $47 off I'm trying to do the math in my head, 443? You make about 10% of your money off it in 43 days. And you can see that we're below where I mentioned before. Let's do a few more. I see Phil over here. All right. NVIDIA. All right. All right, NVIDIA had a big drop, and then we're starting to consolidate. You can see that we are starting to trend a little bit higher. We wicked up at the ADMA, and then we closed a little bit above it. We do have a bounce off 171, another bounce off 174. I'm going to look below the 171, possibly around 165, 160 or so. I actually did do a position on this recently. Yeah, I sold the 150, bought the 145 put credit spread. So somewhere around the 150 seems reasonable. You could go 155 as well. That's at the expected move. Let's do a few more. Apple. Have you heard about the new laptop that they're doing? It's like a cheap version of the MacBook, like the Neo or something. It's going to be like $600 or so. It looks like the market didn't particularly like it because they announced it, I think, this candle. It was a down day in general in the Qs, so Apple did drop a bit. I personally probably wouldn't want to take anything on this yet until I see an up candle. So then momentum might bounce back up near the ADMA or so. If you still think that the low is either at 255 or down here is 250, I would go way lower than that. 225 maybe. Sell the 225, buy the 220. The risk return is not great there. You can make about $30 off it per contract. All right, let me look at these questions now. The risk of losing if it moves in between at expiration. Good question, Jeremy. So let's say I did this Apple credit spread and it dropped to in between these prices. Let's say it dropped at 223 or so. At that point, and you didn't do anything with the position, you would get a sign on the 225, but your 220 would be essentially protecting you there. Thinkorswim, I never let it get to that, to be honest, but Thinkorswim, I think automatically will close the bot put around 15, 30 minutes before the expiration date. So what I personally do is I make an alert price on these slightly above the sold put. So 225, I would set an alert around 229, 230. If it touches that alert, I just get out of the trade. Let's see. Josh also wrote, I don't love it. Might be good though. RAM a bit. I guess he's talking about the MacBook.
Yeah.
All right.
Good price though, right? Seems like
$600 or so, somewhere around there. All right. Common beginner mistakes: ignoring gamma risk, especially 0DTE. Those gammas could change your delta very quickly. Over leveraging, having way too many positions on. Personally, if you're just doing credit spreads, you should leave at least 20%, possibly even more of your account in just cash to be able to, one, take some opportunities when the market drops like now, and then you could get more premium on better volatility. And also, you don't want to use all your account just because if a big downturn happens, you could get really hurt off it. Holding unnecessarily to expiration. FOMO is not a strategy. If you're below a sold put on a credit spread with a few days left, don't just hope. I meant to say hopium's not a strategy, not FOMO. I don't know what I'm talking about. It's getting late. But if you're below a sold put and you don't want to get a sign on it, just close it out. That's what I personally think. Chasing premium is a common one as well. So you might see, oh, I can make $300 off a $500 credit spread that I'm doing. So I'm just going to keep doing those over and over. And you might have a pretty low win rate at that point. So just closing things, selling options is probability. You want to make small, consistent wins over the home runs. If you want to go for home runs, you could join SPY ATM, the SRX. It's a lot of the buy side stuff that we do. Small, consistent wins is credit spreads. If you're very busy and you don't want to spend a bunch of time looking at the market, selling options is typically a better way to go. Risk management is more important than how much premium you're collecting. Don't just be like having your eyes water saying like, oh, I can make so much money by selling this credit spread, but then your risk management is off. And time decay is your employee here. Common beginner mistakes. Yeah, Jeremy, do you have any questions on that?
Can you scroll back to common beginner mistakes? Sorry, I've been taking notes on
Yeah, I
this.
already did.
Good job on taking notes, though. It's awesome to see somebody's getting
Yeah.
value.
Never stop learning.
Yeah.
Yeah, Jeremy, if you want to type any questions you have about this.
Yeah.
This holding to expiration one is the one I mess up a lot. Yeah, it's tricky. I personally set an alert price. I'll show you one real quick that I do on my Discord, but let's see if. So every day I do a credit spread like this. I did one on coin recently. I sold the 160 put, bought the 155 put, but then I do an alert price above the sold put. So alert price at 165. And then if it hits the alert price, I typically just get out of it. If there's only a day or two left and it's very close, I might just consider holding on to it. But you have to make sure that you're watching out for it at that point.
Yeah. Might be a good time to kind of go through your Discord and just kind of show people what's actually in here. It's been a while.
Sure.
It's,
It's been a while. So every day I do one of these credit spreads, typically at lunchtime. These are fairly hands off. Again, you could sell a put, buy a put, credit spread, and then you just set an alert price. So, for instance, for coin, you sell the put, buy the put, and then create an alert. And it was 165. You can go at or below, and then that's it. And then if it doesn't hit the alert price, I just let it expire personally. Some people will close it out a little earlier. And then if it hits the alert price, then you either just stop out on it. You don't necessarily lose here. So if it just touches 165 and there's a day before expiration, you might still be able to close it out less than what you sold it for. We're essentially like a business where we're selling products first to people, and then you're either looking to buy it at a cheaper price later, or you essentially quote unquote got it for free because it expired. So imagine getting a bunch of stuff for free at like a junkyard and then you're selling it. But we do the positions in reverse. You sell it first and you get the premium right away in your account. And then you just want data to decay it out. So yeah, I do one of these every day. The 0DTE, I sell these that expire the same day. It's a similar way that I write it out. We did a call credit spread today on a 6930 call. And then I do a 10 whiff on these, 6940. And there wasn't much premium today because the market was moving quite a bit higher right at open. So I was a little reluctant to do it, but I still got the $25 off 1,000. So it's still about 2.5% on a day. And I'd give the information about the trade as well. Phil says, I've improved my own strategy by closing early. To me, it's not worth the extra risk for a few extra bucks. Yeah, that's definitely fine, especially if you have the time to look at your positions and you see that you're able to close it out early. There's nothing wrong with that. Jeremy also wrote, do I mostly use TradingView and Thinkorswim? Yes, personally. Use Robinhood mostly on your phone. That's perfectly fine too. Robinhood's fine for longer dated credit spreads. Like if you're doing something like this, perfectly fine to do that on Robinhood. If you're doing 0DTE on Robinhood, though, you got to be more alert on it just because it's a little harder to manage. I forgot if they actually do stop orders off spreads or not.
Yep.
Yeah, Josh says TOS and Tasty Trade are popular. Yep.
Yeah, I use both of those.
So yeah, real quick, other things that you get in my Discord. You have the spreadsheet of all my trades, and then I have a insane amount of strategy guides on pretty much all of the selling I have. It's about 45 different. This is just a table of contents, and all of these you click on, and then these have additional notes on it. I was even doing handwritten notes at one point.
I remember that.
Yeah. So if you want to learn more information about what I do, these are all different guides, and I'm available on Discord. I get a lot of questions throughout the day, one-on-one, and also in the group chats.
Yeah, so if you want to learn this stuff, I've never found anybody better than Lance to teach this stuff. Look at all those guides. It's like every sell-side strategy you can imagine.
Yeah. I don't even know if there's any others besides what I've already wrote here, because it's literally 13 pages of guides at this point.
Well, the best thing about Lance is he's very approachable. So he's one of these guys who's an expert at what he does, but it's also easy just to like say, hey, can you jump on a Zoom call? In fact, you do too much for subscribers a lot of the time, right, Lance? Like you're always available. It looks like our pictures haven't come back. It's like a black screen.
There we go.
So yeah. So guys, I'll post a link for you guys if you have enjoyed the content Lance has given you tonight. I'll post a link right now. If you're watching the replay, it'll be in the description below. But if you're watching live now, it's going in the chat. So that's a big discounted yearly subscription to join Lance's Options Teacher Discord, and it's significantly discounted. Should we go through what they get for that, Lance?
Yeah. Do you want to share the link? on your end?
Sure. Let me just pull it up on here. Let's see. We can kind of go through what exactly we get. Just give me a second. If there's any other questions about what you were talking about or what's included here, definitely worth checking out. Just have to actually get to the link and go through what we actually put in here. Okay, so yeah, it works. All right, let's see. So you think I'd be able to work this better by now? Share screen, window. Not seeing my tab that I need to pull up here. Just hold tight. Let's see. I think I've got too many tabs open. Ah, here we go. All right, I found the right one. All right, hopefully you can see that option teacher Launchpass link that I just put in.
Yeah.
You see that? Okay, let's put it full screen. All right, so yeah, this is what you get. So maybe we go through each one of these and explain what the alerts are and things would be pretty useful for people.
Yeah, so we do daily put credit spreads like the coin one I showed. I always talk about what I'm looking to consider to do the day before. And then sometimes the next day, we might change the strike price or even a different ticker. You get 0 DTE credit spreads as well. I'm gonna add on a one-on-one Zoom call. So if you have any general questions on the strategies, risk management, how to possibly allocate your funds based on your account size and your risk, we can talk about all that, or just how to set up the trades, like if you don't know how to manage, stop outs and whatnot. And you get all those crazy 40-something strategy guides as well. And this also, you could ask me questions on the Discord and group chat. So I am not only a science teacher, I'm an option teacher. So I love hearing all these different questions that I get for many different members. And it's like a whole nother way of teaching people.
Yeah. What's your win rate for the daily put credit spreads and the 0 DTE SPX stuff? It's been a
I don't
while.
know at the top of my head. I'll have to look it up. I know for the 0 DTE, last year was pretty decent if you didn't count a lot of the paper trades, because last year I was actually putting the paper trades on the spreadsheet. The year before was really good. I think it was like 50% gain.
50% account growth. That's pretty
It was
good.
around, I think it was like 48% or something like that.
Yeah.
From the year before. And then if you didn't count the paper trades from last year, it was around the 20% or so.
Okay, cool. All right, yeah. So let's call it a night there. If you guys have any more questions, we can give it another couple of minutes, but it's been a full hour. Hopefully you've learned something from Lance. You still got the opportunity to ask him a few questions before we wrap it up.
Yeah, I'll stick around another 5 minutes or so.
Let's
If you
go
have any
down.
questions on it.
Yeah. Good. So yeah, any questions at all? Jeremy says very helpful. Thank you. Good. I'm glad.
Yeah, thanks.
Yeah.
Melinda said, is there a way to just pay for the daily put credit spread alerts? I mean, if you join on the just general link that I have, you could, but this is a good discount. It was a 50% off, I think, for a year.
Yeah. Yeah. Shall we post a link for, what is it? Just the daily put credit spread alerts? Do we have a
Yeah,
link?
that would just be the quarterly plan.
The quarterly. Okay. But that's, you also get everything included here for that as well, for just the quarterly.
Right. And this does give a Zoom call. The quarterly doesn't give a Zoom call as well.
Right. So yeah, I can post the actual page. It might be interesting to post the actual page for the option teacher, so you guys can see all the things, because we've actually not talked much about what Lance offers in general. So here's a link. I'll post it in the chat. I actually just switched my thing here, so let's go back to the landing page right there. So I've got a link here for everything that Lance actually offers in Option Teacher. So I'm posting that in the chat now. It'll also be in the description below if you're watching the replay. So that is pretty interesting. We could actually go through that really quickly too, because you've got some really cool services that we haven't even talked about yet. So it's worth kind of going through. So let's take a look at that. Hopefully you can see it on the screen now. Yeah. So this is actually the landing page for all of the services that Lance offers. So we have a lot of stuff in the Discord. I really like the futures stuff. So if you're interested in selling on futures, there's some really good advantages to doing that as well. So that's actually part of the Discord as well. It's not what we've been talking about here, but the future stuff is probably one of your favorites, right, Lance?
Oh yeah, I love selling those futures. So we actually have 100% win rate on the weekly futures that I sell,
For
and
3 years, right?
well, I think it's like 3.5 years at this point.
With no losses. Isn't that incredible? Absolutely incredible. And the reason for that is the leverage, right? Like you can go further out of the money and still make some decent premium. So it's very safe. It's really
Right.
good. Safeguard trades. So you guys can just browse through, see some of the different things. The thing we're talking about today, though, is actually the quarterly subscription right here. So this is what you get with the put credit spread alerts, the ZOD to ESPX, 3 months. I think the 3-month SPY's actually been removed, right?
I'll occasionally do some when the volatility is high, so there might be one coming up pretty soon. Last year at the volatility low, there weren't many opportunities for it.
And so we could also put your email in if people wants to contact you for more information. You can actually put in your email for people to email you just in case there's more questions that haven't been answered here. So here's Lance's email. It's in the chat box. LanceKaminsky@gmail.com. All right. So Cakeinator's asking what's the average monthly return for selling futures? What we at these days? I haven't been taking
futures. For the weekly puts that I sell, it was around 28%. Pretty much every year, it's between around 28 to 32%. For the covered strangles on futures, we over doubled the account last year and haven't had a loss since we started the service. I know Jeremy's asking, don't know much about trading futures. Yeah, you don't necessarily need a ton of capital in order to actually take the trades, but you got to be very careful about the proper allocation size because futures are highly leveraged products and you have a large notional value of them. So if you do want to learn about futures, you can join on the safeguard trades or the consistent passive profits, where those are lifetime access and there's a lot of guides and you could ask for help on futures. I personally like futures possibly more than even the credit spreads, just because the returns have been really good. It's fairly hands off, and I'm just used to doing them by now at this point.
Yeah. I thought Cakeinator was in your services.
Yeah, Cakeinator, you've been getting access to these for about 2.5 years now, where we've been doing covered strangles on futures.
Yeah.
Check
Definitely
out the covered strangle Discord channel. There's a separate channel for it.
Yeah. Definitely check them out.
We had another member earlier today. I heard your safeguard trades are working well. Like, you stopped doing them? Like, no, I've been doing them every month since we started the service, and we haven't had a loss in what, year and a half, I think.
Yeah, the Cakeinator is saying there's been a lot added since he joined.
Yeah.
Yeah, it grew quite rapidly over the last few years. Quite a lot. So anyway, hopefully that was helpful. I think call it night unless there's any other questions. Hopefully we'll see you in the Option Teacher Discord. It used to be called Theta Traders, but then we rebranded it to Option Teacher, partly because it's more appropriate because Lance is a phenomenal teacher, and that's what he does best, is teach people options and chemistry, right?
Forensics next year. I'm getting that ready. We're gonna do forensic science. Yep.
All right.
We got a lot of serial killers we got to research next. Not me, of course.
All right, I'm dropping the link one more time to the annual subscription, the heavily discounted subscription to come and join Lance at Option Teacher. Hopefully you've enjoyed tonight. I certainly have, and it's always good to have Lance on here. We'll probably do another one on something else pretty soon as well. Do something
Yeah,
on the futures.
we'll do another one on the buy side soon too. Could have Phil in there as well.
Yeah. All right, Lance. Well, thanks very much for
Yep.
being on tonight, and hopefully you guys enjoyed it.
Yep. Have a good night, everybody.